Hi everyone, I'm Paul and welcome to my review of Lesson 21 of ICT's 2022 Mentorship Program. Today's video is going to be a little bit different because we're not going to be applying the mentorship model as ICT's been teaching it to date. Rather, we're going to be applying the entry techniques to a trend continuation model or a trending market. We're also going to build on the more recent lessons as to why you should be using the dollar index or the Dixie in your market analysis. But before we jump into today's video, make sure you subscribe to my channel if you haven't already, and make sure you turn on notifications so that you never miss an update. Lastly, if you enjoyed today's video, please make sure you give it a like. This will help other people to find it, and it's a free and easy way for you to support my channel. Now that that's out of the way, let's jump into today's video. Today's video is Lesson 21 in ICT's 2022 Mentorship Program. And our outline for today's video, firstly we're going to be covering the US dollar index and how and why we should be using that in our analysis. Then we're going to follow on with some trading concept examples using the dollar index versus the S&P or the ES, and then some specific examples using entry techniques in this trend continuation model or a trending market on the ES on the daily, all the way down to the 1 minute chart on the 26th of April. So we've covered the dollar index or the Dixie or the DXY in some of the previous lessons. We've talked about correlation. So we know that the Dixie is negatively correlated to other risk assets. So that's, currencies, stock indices, and of course cryptocurrencies. And this is because the US dollar is seen as a safe haven. And so what you'll often hear is that when it's a risk-off environment, so when the market is, bearish on risk assets, there'll be a shift of funds out of these risk assets and into US dollars. And this is often seen as a flight to quality or a flight to safety. So you'll often hear those terms, bantered around when the markets are quite bearish and they're at, cycle bottoms, for example. So equally or conversely, when it's a risk-on environment, you'll see money coming out of those safer assets, so out of US dollars, and go into risk assets because those monies are then looking for, a higher rate of return. And so why is this the case? So really simply, the US dollar is generally the denominator for a lot of these risk assets. So if you look at any of the currency pairs, for example, you'll see if we look at the euro, it's denominated in US dollars. And this is obviously the same for cryptocurrencies. You'll see Bitcoin denominated in US dollars, and obviously for any of the US stock indices, they're obviously denominated in US dollars as well. And so by their very nature, they're inversely related to the value of the US dollar. So in the case of the Euro USD, if the US dollar goes up, the value of the euro will be going down, for example, and the opposite is also true. And finally, from a macro or fundamental perspective, the US dollar is seen as the world's reserve currency, meaning that most countries' central banks will hold US dollars in their reserves, and it's also the most commonly used currency in international trade. And so this is why understanding the relationship between the Dixie and other risk assets is really critical, because we can be using our analysis of the Dixie to create confluence with our analysis of other risk assets. So the example that we're going to use today is that we're bullish on the Dixie, so we're expecting the US dollar to go up in value, we're expecting higher prices, and so therefore in our analysis on the S&P or the ES, we should be expecting lower prices on the S&P 500. And this would also be the same case for other risk assets like crypto or currencies, is if we're expecting higher prices or expecting, bullish price action on the Dixie or the US dollar, we'd be expecting the opposite on those particular risk assets. And this comes back to that point we made on the previous slide, is because there's a negative correlation between risk assets and the Dixie. And so looking at a specific example now, what we're going to do is take a look at the Dixie, and this is just after the setup that we looked at in lesson 20, where we were, bullish on the Dixie. We were looking for higher prices after an initial pullback. So this is that same view. We've just split the screen between the Dixie here on the top, and we've got the S&P or the ES here on the bottom. And all we're really trying to demonstrate here is that there's this negative correlation. So you can see from these two relative points in time, this is on an hour chart, for the Dixie and the ES. You can see we were bullish on the Dixie, and you can see we've had high prices. So this is a bit of a line of best fit here with this blue arrow. You can see the market's clearly gone up and trended up over this whole period. And conversely, if we look at the S&P, because we're bullish on the Dixie, we should be bearish on the S&P, and you can see that's exactly what's happened. If we have, again, this line of best fit, you can see we've had a trending down market or lower prices on the S&P. And so when we're looking at our setups on risk assets, for example, we can be using that analysis we've done on the Dixie to then build confluence. So we have more confidence when we go in to take directional trades on our risk assets. So like in this example with the S&P, we can feel more confident looking for bearish setups in this example because we're expecting lower prices on the ES and obviously high prices on the Dixie. So we're going to move over to looking at the S&P 500 or the ES now. So coming into our analysis on the S&P, we've looked at the Dixie, and so we are bullish on the US dollar currency index. So we're expecting higher prices on the Dixie. So conversely, we should be expecting to see bearish setups, or we should be expecting lower prices on the ES because there's that negative correlation. So if we do find that, that means we've built confluence, and we should have more confidence in terms of our setups going into the ES. So if we look at the ES at the moment, you can see in this particular move, we've taken out the buy side liquidity, these relative equal highs just here. The market's then painted a swing high and started to trade lower. And the particular marker that ICT talks about is this order block here, this bearish order block. You can see the market trades back up into that. We paint another swing high just here before the market starts to sell off, and we start attacking these relative equal lows here, and obviously this sell side liquidity resting down here. So you can see in these big down close candles we have in this particular move, and this last one in particular, you can see we don't actually take out those lows. We don't attack this sell side liquidity relative equal lows here, but our expectation is that we will. So we don't know how far we'll go through that or what will happen once we've pierced those relative equal lows. It may continue lower, but our expectation in the near term is that we're going to attack the liquidity that's resting there in the near term. So we're expecting lower prices, and that's in line with our analysis that we've done on the Dixie, so we know we have good confluence in this particular viewpoint. Now, if we zoom into our 1 hour chart, I'll just orientate us in terms of what we're looking at. So the market's traded up into that bearish order block that we talked about from the daily, and you can see this is that then big sell-off that we've had once we painted that swing high on the daily chart. Now, if we zoom in a little bit closer, you can see this is that move that we had as we start to attack the sell side liquidity relative equal lows down here, and then that sell side liquidity that was resting lower. Now, what ICT talks about in lesson 21 is that we had this big move, and then we had a bit of a retracement, and what he was expecting was for the market to trade back up to this 43.20 level. And the reason why he was expecting that is if you take your fib and you run it from this particular move, so from the high of this move to the low of this move, then you get this sort of OTE type setup that he talks about in some of his other videos. So we won't go into a lot of detail about that, but effectively all it is a retracement back in the range up to this pocket up here just above this sort of 62 mark on the fib, and that's what he calls his OTE. So again, I won't go into a lot of detail about that. So that's why he was expecting the market to go that little bit higher. And as we've talked about in the mentorship model, we generally talk about a premium and a discount range. So this would obviously be the discount part of that range and the premium. And so what ICT was looking at was not only for the market to go up into premium, but to go that slightly a little bit higher for that optimal trade entry that he talks about in some of his other videos. So if you're curious, that was why the market didn't do that. So he didn't get exactly what he wanted, but we did have this pullback as we then go into the 26, which is what we'll look at as we go onto the 15-minute chart now. So zooming into our 15-minute chart now, we're just looking at our London Open part of the session. So this is just immediately after midnight New York time. And just remember, the London Open is from 2 o'clock New York time, so that's just here, to about 5 o'clock New York time in the morning, which is just here. So we have our midnight New York time, and then we have the midnight open. So that's the first of the opens that ICT looks at in his setup, and we've talked about that in the more recent videos. Now, what we'd traditionally be looking for in the mentorship model is due to swing. So at the open, so whether that's the midnight open or the 8:30 open, we'd be expecting, in this example, higher prices because we have a bearish outlook. So we're expecting the market to go down, but we're looking for that initial due to swing above the opening price. And so this is in line with ICT's power of three. So that's accumulation, manipulation, and distribution. And so what we'd be looking at is if we have our opening price just here like this, so the market is opened, and then what we're looking for after that is for price to trade, then trade higher. So this is our due to swing, we get that trade higher, and then the market will come back down. So this is that accumulation, manipulation, and then we get a run down to another liquidity point at some point in the session, and that's where price will start to gravitate towards. So we have smart money getting in here, and we have them getting out here at another liquidity point at some point in the session. So that's sort of principally what we're looking for. And the reason why that's not applying in this particular session is we just don't get that. So as you can see, the market basically comes into that midnight part of the session. We never go above the midnight open when we just touch it here, and the market just trails away. We do get a break in market structure, but we don't get that traditional liquidity grab that we'd look at in our normal setup in our fair value gap model. It just continually trades lower. We don't get that due to swing, and you can just see the market trades away. Now, that doesn't stop us from actually having setups made available to us. And you can see in this particular example, remember we're inside the London Open, so that's from 2 o'clock, so I can just mark that out here. So from 2 o'clock and then again till 5 o'clock, we can be looking for setups in this particular part of the market. So as I said before, we'd be looking for a bearish setup for price to go above that midnight open, take out liquidity higher. That hasn't happened in this example. We just have the market go lower, immediately lower, and then trade back up in this example into this order block here before trading lower. Now there's actually a fair value gap here as well. So you can see that just here. If I take this order block away, you can see we have that traditional 3 candle setup. So 1, 2, 3, and we have the fair value gap formed between the low of the first candle and the high of that first candle. So in terms of our setup, we would obviously look at going at a limit to sell at the high of that third candle and have our stop up here or up here, because we obviously still have an imbalance up here. So the market could definitely come back up and fill in that imbalance before potentially going lower. Now, if we were looking at taking that trade, this is how that would look. As I said, you would have your limit at the high of that third candle, and you would have your stop up here at this swing high here to protect against price going up into that second imbalance that's higher than this one. Now, if we just run the market forward, you can see what happened for the rest of the session as we go out of the London Open and into the New York Open. So there you go, we won't play it all the way through, but you get the idea. Pretty much from the midnight open, and we have our 8:30 open here. So this is as we go into the New York Open session, which is part of that 2022 mentorship model that IC's been teaching since the beginning. You can see that the market just never has that opportunity to go above the open. It's just trading continuously down. And you can see, even if we'd taken that fair value gap setup from London and traded it through, you can see, we would have had a good 3+ R return there taking that particular setup. But again, this is different from what's been taught in the mentorship model because we don't have that due to swing. We don't have a grab of liquidity prior to the setup occurring. The market's just too heavy. It never gets any opportunity to rally. It's just continuously falling over the session. We do get a little bit of consolidation here around in the lunchtime part of New York before the market starts to trail off again afterwards. And so what this tells us is that the market in this particular session is extremely bearish. we get no due to swing above the midnight open. And then again, when the 8:30 open comes, again, we don't get any due to swing there either. The market just continuously sells off as each of those opens occurs. And so what this means is that the mentorship model is not going to be present in these sessions. As I said before, we're not going to get that grab of liquidity prior to the fair value gap being set up. And so in this example, only continuations are really going to be successful. We're not going to get more of a reversal type of setup in terms of applying ICT's concepts on this particular session. And so that's not to say that we can't use the fair value gap setups. We just have to be aware that the draw of those relative equal lows and that sell side liquidity that we talked about earlier in the video is just extremely strong and is going to be drawing price down towards those levels. And so we need to be looking for bearish setups, so bearish fair value gap setups on the way down to take advantage of this particular move in the market. And so in terms of hunting for these particular setups, we're just going to run through some of the screen grabs from ICT's video because my data unfortunately doesn't go back far enough. But what you can see is that we have fair value gaps that are setting up across different time frames, so across our execution time frames from 5 minutes down to 1 minute. And really what we're trying to do is just catch these as an entry because the market's so heavy, it's so bearish that it's drawing towards those relative equal lows. We're just looking for any of these as opportunities to get into the market. And so you can see from ICT's screen grab here, we have this first setup that occurs just here, but there's actually more in this particular chart as well. So you can see we have another one just down here, and you can see the opposite of what we've had in the mentorship model to date. We don't have a grab of liquidity prior to this setup, so you can just see we have the setup, the market trades back up into that fair value gap before selling off. And again, we get the same thing here. We get this fair value gap form, so we have that big drop in price. We have a small pullback into that fair value gap before the market sells off again. And so just the same as we would in the mentorship model, we would have our stop either at the swing high up here or at the high of that first candle. And again, the same thing here, our stop would be there. And you can see these are pretty easy trades to jump in on in terms of taking advantage of this bearish trend. Now, the other thing that I think is worth noting, and ICT doesn't mention that in this video, but he talks about it in other videos as well, as we have a bearish downtrend. And so these up close candles sort of act like little speed bumps in terms of that move. So you can see we have these up close candles here, but the market never trades back up into them. And again here, an up close candle here, the market doesn't really trade back deeply into that. And so these sort of act like resistance, if you like, on the way down. And it's not really until we get into this lunchtime session here that we get some consolidation again. And this is why ICT talks about not taking setups in lunch, because this is when you have a bit of funny business happening. The market gets a bit thinner. So you can see the market's trending very strongly. We go into lunch, it sort of chops around a bit, and then you can't see it in this chart, but afterwards the market then sells off again. So it resumes the downtrend after lunch. And so again, if we look at the 4 minute chart, we have the same setup or in the same vicinity again at that 8:30 open. So we have our bearish setup just here, and it gives us another opportunity to get in. You can see these are actually all through here. So we have another one just here. And again, that one we talked about on the 5 minute chart just there. So there's a number of opportunities to get in on this trend using the fair value gap as an entry method in this trend continuation or this trending market type model. Now, one of the things I think is worth mentioning, and I've picked this up in a lot of my back testing, is that the fair value gaps that you want to use is when you find them on multiple time frames. So for example, this one we looked at just here and this one here were on the 5 minute chart as well. And so one way of looking at it is if you find a fair value gap on, say, multiple time frames, then that gives you again more confidence that that fair value gap is like real and it's one that you can rely on. Whereby if you find a fair value gap that's only available on, say, one of your execution time frames, so say like the 2 minute chart, but it's not available on any others, well, that should give you less confidence that that's a really, genuine fair value gap. So what I find is when I find them across multiple time frames, so as I said, we found fair value gaps on the 5-minute in this region and this region, that would give me more confidence in taking both of those setups. And so again, our 3-minute chart, you can see that's that same fair value gap setup that we had here at that 8:30 open. And you can see again, this one there again, which was again from the 4-minute chart. And this is that one from the 5-minute. It's obviously got multiple imbalances in it, and you would just choose which one you'd want to take. In this example, what I would do is I'd run my fib from that high to that low and try and find the midpoint and just see where that makes the most sense. Obviously, if you just eyeball it, it obviously makes sense to be taking that one. You wouldn't want to be getting too greedy in this particular type of environment because the market is just too heavy. It's only really retracing a small amount before selling off again. And so, taking the most obvious fair value gap is going to be the, sensible approach in this type of environment. And now finally on our 1-minute chart, again, we have confluence across these fair value gaps across multiple time frames. So this is again that one that we've had on the 5, the 4, the 3, the 2, and the 1. And then again, this one I think was on all of the time frames except the 5-minute. And then this is that other one that we've had across the multiple time frames as well. So again, this is, I think, a really important point. ICT didn't mention it in this particular video, but it's certainly something that's come up in a lot of my testing, is that you want to see fair value gaps across a number of your execution timeframes to give you that confluence, and then obviously the confidence that it's a valid setup and there really is an imbalance there. It's just not an aberration on that specific time frame. Thanks for watching my review of lesson 21 of ICT's 2022 YouTube mentorship program. I hope you found today's video helpful. If you did, it would be great if you could like it because that helps other people to find it. And if you enjoyed this content and you would like to see more videos like it, make sure you subscribe to my channel and turn on notifications so that you never miss an update. Thanks for watching, and I hope to see you next time.